Is it truly possible to predict a recession? Well, we're here today to answer that very question. After analyzing more than 80 economic reports, we've pinpointed the ones that exhibited the closest correlation to the last recession. We've narrowed it down to 5 economic studies that were most closely correlated to the markets, which occurred between 2006 and 2009. This exhaustive study includes 80 of the most widely tracked economic barometers, including non-farm payrolls, retail sales, and building permits. Analyzing this data over a 4-year period with over 3,800 individual data points, this is by far the most comprehensive study we've undertaken. Our goal is to identify which economic barometers most accurately define the bull markets of 2006 and 7 and the subsequent recession and market crash of '08. While all reports and surveys provide us with valuable insight into the economy, we've narrowed our focus to only the most reliable data sets. The benefit in doing so is to create a template so we can then determine the strength or weakness of our current economy. And by the way, number one on the list is probably going to come as a surprise, which you did not expect. Starting the countdown with number 5, we begin our discussion with non-farm payroll services with an 87.7% correlation. Establishing a high mark of 2.1% in March of '06, this indicator marking year-over-year growth tracked very closely with the S&P 500, precipitously declining to a negative 3.2% in August of '09. Given the U.S. economy is predominantly defined by the service sector, it is easy to see why the strong correlation exists. Now moving to number 4. We move to the manufacturing sector, specifically manufacturers' new orders, durable goods, ex defense. In March of '06, this barometer of new orders placed with manufacturers registered a yearly increase of 20%, only to dramatically decline to a low of negative 39% in March of '09, coinciding with the depths of the stock market crash occurring in the same month. Excluding the defense sector, new orders for durable goods proves to be a valuable gauge of the U.S. economy. Continuing the countdown to number 3, we consider the manufacturer's capacity. The Capacity Utilization Index measures how much of the total available capacity in the various industrial sectors are being used. Those industries include manufacturing, mining, and gas utilities. In September of '06, capacity utilization peaked at 2.1% before starting a long decline along with stocks, finally reaching a bottom in June of '09 at negative 16.3. Closing in on number 2. This survey measures the output of the manufacturing, mining, and electric and gas industries, industrial production, with a 91.3% correlation to the S&P 500. Industrial production reached a peak of 4% in September of '06, following the S&P 500 lower, ultimately reaching lows of negative 15% in June of '09. Given nearly all goods we consume are manufactured, industrial production is closely correlated to the U.S. economy. As we've now reached number 1 on our list, please note this is merely a summary of a very extensive discussion that can be found in our Substack newsletter. We'll include a link to that article in the comments of this video. But now to the economic report that demonstrates the absolute closest correlation to 4 years of stock market data. The Passenger Transportation Index with a 93.5% correlation. This gauge reached a high of 6.9% in August of '07 and trended lower in a very similar pattern to stocks, ultimately reaching a low of negative 8.1% in June of '09. It is logical to conclude the use of public transportation is closely correlated with economic growth and, as a result, also connected to stock prices. In just a moment, we're going to look at these 5 economic reports and see what they say right now about the state of the economy. But first, I thought it would be also interesting to consider those surveys that have the absolute lowest correlation to stocks. The 5 reports with the lowest correlation to the S&P 500 are as follows. Philly Fed current inventories, building permits for single-family units, Philly Fed unfilled orders, housing units for 2 to 4, and average hourly earnings. While every data set can provide us with insight into the inner workings of the economy, not every monthly update necessarily is indicative of the future trend in financial markets. It's helpful to keep this in mind. While on a day to day basis, the news may seem very substantive, we should also consider its impact to the markets, and sometimes none at all. In particular, the average hourly earnings also shows nearly a zero correlation to the S&P 500. At both times, they'll move in the same direction, opposite direction, or completely independently. This now leads us to our present date. With our top 5 most correlated economic reports, what do they tell us about today's economy? Over the past 2 years, the non-farm payroll services has declined from 5.3% to a current 2.0%. This current trend to the downside is moving counter trend to an ever rising stock market. While it is logical to conclude the labor market and stock prices should trend in the same direction, lately appears this divergence only continues to widen. Manufacturers' new orders, durable goods ex defense has declined from a lofty 15.3% to a current 5.8%, indicating the demand for those long lasting goods has wavered. Capacity utilization began the year 22 registering an 8.1% year over year return, but quickly declined to a current negative 1.4%. It appears that while stocks continue to climb, the percentage of manufacturers' capabilities are not being used. Industrial production has followed in similar fashion to the prior report, declining from 6.6% to current figures just fractionally above zero. As both of these indicators speak to the strength in the manufacturing sector, it is logical to be skeptical of their near term prospects. And finally, Passenger Transportation Services Index reveals the steepest deterioration from an 82% year over year report to just 2 years ago, from 2 years ago to a current 9%. As the survey reports the demand for public transportation, we may conclude these services has declined along with overall economic growth. Comparing the current progress to the chart patterns of '06 through '09, it certainly does highlight a stark divergence from the S&P 500, achieving new highs on a regular basis. What does the future hold for us? It certainly does appear that stocks have run away from the economic reports, but the story is not finished. Every day we learn a little more about the fascinating economy and our future prospects. Once again, a complete analysis can be found in our Substack newsletter. Just visit substack.com and enter our info, and you can read all about this and all of our other publications absolutely for free. We hope this has been helpful. We look forward to seeing you back soon.